Hello, it's Mike Preston at New Harbor Financial. You know what? There's just never a shortage of things for investors to worry about. It's a complicated, scary world. Inflation, interest rates, the Fed, geopolitics, elections, recession fears, everything's always changing. During times like these, it's often our own decisions, not the market itself. It's our reactions that have the biggest impact on our long-term success. Today, I want to talk about three investing mistakes we frequently see investors make during periods of uncertainty, and more importantly, how you can avoid them. Mistake number one, FOMO. What does FOMO mean? If you haven't heard about it, it's fear of missing out, getting caught up in the tape. This is really probably the number one mistake that we see people getting caught up with. Why is this so common? It's so common because we're herd animals. Really, we're animals and we like to be with the pack. It feels better, it's safer, we're protected from predators. And so we want to go with something that's working. We want to go with the crowd, but it's exactly the wrong thing to do many times in investing. Now, there's times where you do want to go with the trend, but the times that really tug at your emotions, they tug at your heartstrings, those are usually the wrong times to jump in. The hot IPO, the trendiest tech stock, the trendiest AI stock. Sometimes it works out, but a lot of times when things getting really hot, and it's in the news, and we have all kinds of clients calling about it at the same time, you know that it could be a little bit of a frothy time, and you want to watch out and make sure you don't have FOMO. This also happens in parabolic up markets, when everyone's just piling into the market in general. We've seen some of that in the last 10 plus years. So be careful about that, your emotions, and be careful about FOMO. Just remember what Warren Buffett said. He said, be greedy when others are fearful, be fearful when others are greedy. Don't always be a contrarian. Don't always do the opposite, but be very careful about doing the same as everyone else. And so how does this fit into your long-term investment strategy? Avoiding FOMO falls into the category of avoiding the big mistakes. If you can avoid the biggest mistakes in investing, you can do a lot better. You can really improve things. You can get to know yourself a little bit more because believe me, the market is an expensive place to figure out your psychological weaknesses. Mistake number two, no risk control or putting all of your eggs in one basket. Why is this so common? The people's psychology makes them sell winners and keep their losers. It's really hard to hold on to a winner long term. So when something goes down, we want to hold on to it. When something goes up, we want to take that loss quickly. People think that a loser will always come back. It's not true. The losers don't always come back. Sometimes they do, but they don't always. How can you avoid this? Before you get into a trade, write down somewhere at what level is it that you're wrong. This is called a mental stop. You don't have to put a hard stop in the market. You can use a mental stop. Just write it down. Use a notebook. That way you can be honest with yourself. Now you can always change it later. You can revise it. You can do whatever you want. But being honest with yourself means at what level do you think you might be wrong here? And do that before you get into the trade. You should think about this as not letting 1 to 2 trades knock you out of the game. A lot of people put all their eggs in one basket. They go really hot and heavy in one sector or one name. And if it goes bad, not only do they have trouble selling losers, but one bad trade can just knock them out psychologically and financially. Don't let that happen to you. And what does that mean for you long term? Diversification. As boring as that sounds, diversification will help you out. And it'll also be a more comfortable ride psychologically. There's no need to stress yourself out really too much mentally. Just have your positions be at a level that you can stick with them. The third mistake really is overtrading. Being too close to your account, watching it too closely, having too much activity. There's a number of different mistakes that can come out of this. You can sell a position as soon as it moves against you, but hasn't hit your mental stop. That's often a mistake. I mean, not always. That's the hard thing about investing is sometimes you can cut a loss quicker than before it hits your stop. But a lot of times I've seen investors, the second it goes against them, they jump out quickly, only to watch it reverse in the intended direction. So you have to give your positions time. Investing is not an exact science. Let your idea work out. Have an idea where you're wrong. Make sure you do write it down, as I said previously, to keep yourself honest. People have the misconception that if they do more things, if they have more activity, then they're doing better. They're having more production. But in investing, it's really oftentimes doing less. Sometimes walking away, turning off your screen, just getting away from the computer is better off. You know, the famous Jesse Livermore, the famous trader, the book that the Reminiscences of a Stock Operator is about. It was wrote under a pseudonym, but most people credit that to Jeff C. Livermore. He said it was never the activity of the trading that made him the big money. It was the sitting tight. And that's true. If you got a big winner, just you got to sit tight and don't overtrade. Let it run. So how do you know if you're falling into this trap? Really, if you're seeing that your winners continue long after you sell them, you're selling probably too fast. If you're holding a bunch of losers and you don't have a lot of winners in your portfolio, you're probably holding your losers and selling your winners because that feels better psychologically. So be careful about that. Take time away from the screen. It's one of the best things you can do. Develop your style and just step away. Now, one of the hardest things to do is develop your style, whether you're a person that wants to focus on one sector like basic materials or commodities or resources or miners or tech stocks or biotech or whatever it is. Develop your style, your flair, understand your own psychological weaknesses and strengths and develop a style around that. Uncertainty is a normal part of investing. You have to anticipate and accept and expect uncertainty. It's not something that eventually disappears. It's always going to be there. We can't control markets or headlines. We can control how we respond to them. Psychological control is the most important thing in investing. Unless you're just index investing from a young age over 50 years in the S&P 500 or even in a global ETF, and avoiding common investing mistakes can be just as important as making good investment decisions. Avoid the big mistakes and you could be far ahead of a lot of other people. So in summary, markets will always give us reasons to worry. The key is having a process that helps you make thoughtful decisions instead of emotional ones. If you can take the psychology, the psychological weaknesses out of the game for you, you can do much better. Don't forget to like the video. Don't forget to subscribe to our channel. Thanks for tuning in, and we'll see you next time. I'm Mike Preston at New Harbor Financial.